There are a small handful of very powerful events, I call them plays, events. And one of those events is the elephant bar. This is event number one. It's the elephant bar. Now, you can have a bullish version or a bearish version. Draw in the elephant bar. That can be red for bearish, it can be green for bullish, but this is event number one. Event number two can be something like, I'm not going to go over all of these, but this can be a topping tail bar or a bottoming tail bar. Event number two, this can also be the reverse. All right, it can be this. Okay, that's two. And then let's just do three here. And you can have something like the bear 180 or the bull 180, right? Everything else is sort of like a regular to minor artillery item. This is your heavy artillery, and then you have your normal artillery. These three things are the heavy. All right, so I just want to just briefly touch upon these, but I want to give you statistics associated with this. Elephant bars will represent 60+% of all of your plays. 60+%. It's actually closer to 65, but let's just use 60 right now. 60+% of all of your plays. These will represent 15% of all of your plays, and these will represent 5% of all of your plays. They happen less frequently. Now, look at your heavy artillery and look at where the vast majority of your activity is always going to be when dealing with a power play, when dealing with the heavy artillery plays. It's going to be with your elephant bars. Dual space, that concept is when you have your stock gets height away from the 20 at a time where your 20 is separated a decent distance from the 200. So you got three items. You have the price, you have the 20, and you have the 200 all separated apart to create space 1. That's why we call it dual space, and space 2. Doesn't matter which space you number. This could be 1 and 2. It doesn't matter as long as you understand there are two layers. Now, these layers are not always equal in the real world. We can't have perfection where sometimes they're equal, where space 1 is equal to space 2, but not always. A lot of times in the real world, you get the dual space, but the spaces aren't equal, but they're still relatively separate apart. That's right, Kat. We call it I call it sometimes the 3-finger spread. So you've got one finger here, another finger there, and another finger there. There's your 3-finger spread. Anything strong that kicks off a move against the 3-finger spread is very meaningful. This igniting power from the 3-finger spread will tend to kick off something very, very enduring. The more flat the 200, the more powerful it is. Now, that's not to say that if the 200 is slanted like this, that it has no power. No, the 200 is always very powerful. But there are degrees of its power. So when it is flat, it is by far the most powerful state of the 200. And that is in contrast to the 20-period moving average, because the 20-period moving average is more powerful when it is trending upward or downward. So its power is in the trend. The 200's power is in its flatness. And I think that's very important to understand. All right? 20-period moving average is the most powerful when it's trending. The 200 is the most powerful when it's flat. Now, anytime
you get a strong movement up or down from the 200, a flat 200 period moving average. This is, all right, guys, understand this. This is the most powerful moves the market can present to you. Here's an interesting one that happened with CVX today, oil stock. Now, this is coming a long way from under the 200. Okay? So normally, coming from here, it's too late to potentially play this. In a way. What makes this bar originating off the 200 still buyable is the fact that a pause is next to it. If you were to eliminate that pause, that is too late of a buy. So look, you're coming from here, 1, 2, 3, 4 bars up. This bar is too late to buy. But because this pause is there, it signifies that you have one more leg left. One more leg left. So you have to understand that. This is not something where you're looking for the whale because you have the first leg. So you're playing a second leg move. You guys should know, most of you should know, that's leg 1 of a move. This is leg 2 of a move. Sometimes it's like this, leg 1 of a move, leg 2 of a move. And sometimes it's leg 1, brief pause, leg 2. Okay? This one is kind of what we have here. Leg 1, boom, leg 2 begins. But I like this one the better. See, the origin of this is still a bit a ways. This 200 is support when the stock is above it, right? Now, what I love is when a stock comes in hard at the 200, okay? I love that scenario. Now, many people get fooled. A lot of novice traders get fooled once they get a little bit of knowledge about the 200 and they think that's support. And it is to a certain extent, but depending upon how violently or how powerfully you come down to it, it's not lasting support. So if you crash into it, the support is weakened, okay? It's like weakening the foundation of the 200 so that the next attempt goes through. So remember these numbers that I always share with you. Let me do this a little lower. So if you crash into the 200 and you come in hard, you weaken the 200 and there will typically be a bounce. But let's go over these numbers again, right? The bounce, the number of times that your stock will bounce all the way back and make a new high, this will happen only one time out of every 10 on average, okay? The number of times that you get about 2/3 are about 2 times out of every 10. All right? The times that you will get to a half, 6 times out of every 10. And the times that you will get to a bottom third jump to about 9 times out of every 10. It's like 8.5 actually. So you got the 100% takeout of the red, the violent red. You've got the 2/3, let's say 66%. You've got the 50%. You've got the 33%.
Okay. So 8.5 to 9 times out of 10, you're going to get this scenario. Watch this. You're going to get this. I'll do it a different color here. You're going to get this and that. Okay. You'll reach that. Sometimes you'll reach that. Okay. But the higher you go, the more shallow your drop is likely to be. That's where we're going to live our lives. We're going to live our lives to that 33 to about 55 or so. I would say 60. 33 to 60%. That's where I want to live. All right. I want to live in that space on the bounce. That's where I'm going to look to get in to play the next move down. All right. Now, let me clean this up a little bit because I want to show you something that's really going to take you to the next level here. This is going to take you guys to the next level, guys. Very few people know these things, right? So check this out. So we've got remember I told you the 33 to 60, right? So let's take that 33. Let's take, here's about the 50. So let's take that 60 like that. Okay, let's take that box. All right. That's where we're going to get now. We're going to get there. We're going to live here. That's where I want to live. Right there. Now, I want to break that box into 3 parts. Oh, my drawing is terrible here today. 1, 2, 3. Okay. So now what I do, now I'm going to tell you what I do. You don't necessarily, this may not necessarily be for you yet, but I do like to give you advanced previews of where you're going in your development, right? So I will start scaling in into the 3 levels. But let me do this again. But I will scale in a pyramid-like way, right? So I will start scaling in smaller and getting bigger, scaling in smaller and getting bigger. So I will start here little, get bigger here, and be bigger there. Now, that's not necessarily what I want you to do right now, but this bounce in this range is your entry range. Sometimes you're going to not get that far. Sometimes you're going to get in the middle. Sometimes you're going to go all the way in that box, but you're going to live about, I would say on average, you're going to live in this 7 to 8 times out of 10. You're going to be good. All right. That other part gets up there, but 7, that's where we want to live. We want to live 7 to 8 times I'm right out of 10. 7 to 8 times out of 10, I'm right. 7 to 8 times out of 10, I'm right. 7 to 8 times out of 10, I'm right. And you can get very wealthy in that space right there. Covered head and shoulders location, head and shoulders pattern. All right, where like that. And we've covered the reverse of that, right? Which is the reverse head and shoulders. Here's the left shoulder, the head, the right shoulder. Okay. Here's your neckline. And once you break the neckline, okay, here is where your stock should be now more or less obeying the 20 MA most of the time. All right, now I hope you see that. So if we take that here, now I'm going to be perfect like my drawing, but here's your neckline.
Let me do that again. The neckline is not always straight, by the way. You're taking the 2 points of the shoulder, more or less, right? And look at the 20. Look at your 20. It's obeying the 20. Remember, moving averages are an area. So, the chart would have you believe that they are narrow. Moving averages are narrow, thin lines, but they are not. They are areas. All of these things we've had individual lessons on. Left shoulder, head, right shoulder. All right. To have a 20 MA halt, you need several, if you'll recall, you need several characteristics. The stock or the item, first of all, must have spent a good deal of time under the 20 period moving average. So look at we're under the 20 period moving average. All right, this doesn't count. That's a little peekaboo. That doesn't count because the 20 is a zone, right? So don't look at these little mile breaks as breaks. They're not. So we're under the 20, under the 20, under the 20. Criteria 1 is that the stock has spent a good deal of time under the 20. What I mean is that it's not just a brief period of time under the 20 and then goes back like this. No, we're talking about a lot of time under the 20, a lot of time under the 20, a lot of time under the 20, a lot of time under the 20. So that's criteria 1. You need a lot of time under the 20. Then you need a sudden break through the 20. So this is criteria 2. You need a break through the 20. Now, not a peekaboo break, traders. That doesn't count. You need a height. You need a break that gains some height. So your 20 is like this, right? And your stock gets height. Do you understand? Like it gets height. Let me show you. It gets height above the 20. It's not a peekaboo above. It's height above. So it has some height, okay? That's criteria number 2. You get a break with some height above the 20. Now you watch the pullback, and if this pullback is halted, if the 20 halts it by rejecting the pullback, boom, you got your 20 MA halt. So basically a 20 MA halt is nothing more than the first successful retest of the 20 after the stock or the item has spent a lot of time under the 20. So what this concept is showing you is that what was previously the item's ceiling, ceiling, what was previously the ceiling is now the floor,